China just did something that stunned global markets. A move so sudden, so massive that analysts are calling it the biggest silver shock of the decade. For years, everyone thought China was quietly importing silver for its solar boom. But what just happened goes far beyond that. In the span of weeks, China has sucked up more physical silver than the rest of the world combined. And no one saw it coming. And here's the kicker. Insiders say they're not done yet. The data came out quietly, buried in trade reports and custom spreadsheets. But when analysts connected the dots, the picture was staggering. In November and December 2025, China's silver imports surged to over 1,500 metric tons, the highest in modern history. That's more than double their average monthly demand. And to make things even more bizarre, the Shanghai Futures Exchange, China, its own version of COMEX, reported its inventories collapsing by nearly 40% in the same period. So think about that. Imports skyrocketing, inventories crashing. Where's all that silver going? Because it's not showing up in factories, and it's not showing up in exports. Some say it's a simple supply chain restock. Others whisper it's something far bigger, a strategic accumulation quietly orchestrated by Beijing itself. And if that's true, the implications are enormous. Because while the West debates contracts and digital ounces, China might be cornering the real thing. One analyst from Singapore put it bluntly, if COMEX runs on paper silver, China just called their bluff. The timing couldn't be more perfect, or more suspicious. Just as the US COMEX system reports its lowest deliverable silver level since 2018, China steps in and drains the physical market. Almost like they were waiting for the exact moment when the West's vaults were running dry. Let's rewind a bit. For years, China has been the world's largest producer of solar panels, and silver is a crucial ingredient in every cell. Analysts estimated that by 2025, China would need around 200 million ounces per year just for solar production. But this new buying spree, it far exceeds industrial need. Satellite data even shows new construction near several Chinese strategic reserves, rumored to be high-security storage sites. If those rumors are true, China isn't buying for factories. They're stockpiling silver like it's oil. And why wouldn't they? The global financial landscape is shifting fast. The dollar's dominance is under question. Gold has been rising. But silver, the metal that bridges technology and money, has been ignored. Until now. Some believe Beijing's plan goes deeper than energy or electronics. They think China is preparing for a new monetary reset. One where tangible assets, not digital promises, define credibility. Gold for reserves, silver for industry. Together, a new foundation for influence. Meanwhile, Western markets are reacting with disbelief. Traders in New York and London watched premiums on physical silver climb almost overnight. Spot prices ticked up, but the real shock was in supply. Vault managers report delivery delays stretching into February 2026, and suddenly, whispers of shortage are back. The irony is painful. While COMEX still shows silver on paper, the actual bars are heading east fast. One London trader summed it up perfectly. We're selling contracts. They're buying metal. Guess who wins when the system cracks? This isn't just a trade story, it's a shift in power. For decades, the West dictated silver pricing through financial centers. COMEX in New York, LBMA in London. But if China continues to absorb real supply, those pricing mechanisms lose relevance. The paper price becomes just that, paper. Because the true price of silver isn't decided on a screen. It's decided in the vault by whoever actually holds the metal. And the numbers back it up. According to recent export data, major producers like Mexico and Peru have quietly redirected shipments from US buyers to Asia, mostly China. Some refiners even confirmed new long-term contracts under non-disclosure agreements. In simple terms, China is locking up supply for years to come. And if you control supply, you control price. This move mirrors what China did with rare earths a decade ago. Back then, the world didn't take it seriously until prices exploded and Western industries scrambled for access. Now, history might be repeating itself, but this time with a metal tied directly to green energy, batteries, and currency confidence. In Beijing, officials haven't commented publicly, but Chinese state media recently published a curious line: strategic resources will define the next century's balance of power. No mention of silver, but the timing was deliberate. It aired just days before the record import data went public. Some analysts call it coincidence, others call it a signal. China announcing, without words, that it's moving first in a new commodities race. And while the world fixates on gold, silver remains the silent weapon. Cheaper, more industrial, but equally essential. In solar panels, 5G networks, advanced semiconductors, silver is everywhere. Yet, unlike gold, global silver reserves are shockingly small. At current mining rates, proven reserves might last just over 20 years. And if one nation starts hoarding aggressively, the entire supply-demand balance implodes. That's what makes China's move so alarming. They're not buying a commodity, they're securing leverage. Let's look at how the markets are reacting. Since the news broke, trading volume on Asian exchanges has spiked 300%. The Shanghai Futures Exchange premium over COMEX hit a record high, meaning Chinese buyers are willing to pay more than global prices just to get metal. That's unprecedented. Historically, silver flowed out of China. Now it's flowing in, and the tide isn't turning back. Meanwhile, Western investors are waking up. Bullion dealers in Europe and the US report limited availability of 1 kilo bars. Wholesale prices are up, but deliveries? Delayed. It's the same pattern that preceded every major metal squeeze in history, and the tension is rising. Traders know that when China moves this aggressively, it's never random. This isn't panic buying, it's strategy. Cold, deliberate, long-term. Some speculate that China might be preparing to launch a new silver-backed contract, perhaps through the Shanghai Gold Exchange or a state-linked digital currency system. Imagine that. A digital yuan with reserves in both gold and silver, real, audited physical metal. That would be a direct challenge to the Western financial model built on derivatives and debt. And if that happens, COMEX's paper contracts could become obsolete overnight. Because in a world where one side holds real silver and the other holds promises, trust flows toward reality. The West might still control the narrative, but China controls the vaults, and that changes everything. Already, whispers from Hong Kong traders suggest new delivery channels are forming, routes that bypass Western clearing systems altogether, private vaults, state banks, direct exchange settlements, all designed to keep metal inside China's sphere of influence. It's a quiet form of economic warfare. No headlines, no sanctions, just withdrawal of supply from a system that can't print metal. And the world is only beginning to grasp the consequences. Because once that silver leaves Western vaults, it's not coming back, it won't be recycled fast enough, and it won't be re-exported. It's being absorbed, permanently. And when the next shortage hits, the West will find itself bidding against the very country that planned ahead. The question now isn't if this affects prices, it's when. And the signs suggest sooner rather than later. Futures spreads are widening, delivery requests are climbing. Every trader can feel it, that quiet panic that comes when the math stops adding up. For years, the world believed the silver market was balanced. Now, one country's buying spree just proved how fragile that balance really was. China may not say a word publicly. They don't have to. The data speaks louder than any statement, and the message is simple. While others debate value, China is taking possession. The message is clear. While others debate value, China is taking possession. But the moment they did, the rest of the world began to feel the aftershocks. Across Western markets, the first signs appeared quietly. Premiums rising here, shipment delays there. Then, in late January 2026, COMEX traders started to notice something they hadn't seen before. Bars scheduled for delivery were suddenly hold pending allocation. That's financial language for we're still looking for it. At first, officials brushed it off. Temporary logistics issue, they said. But analysts saw the pattern, the exact same one that appeared before every historical squeeze. Because when physical metal moves east faster than its mind, the paper side of the system begins to wobble. One hedge fund manager told Bloomberg off record, "This isn't speculation, this is a run on the vault." By February, the imbalance could no longer be hidden. COMEX futures stayed flat, but physical prices on the street were exploding. Dealers quoting 40, then 50, then 60% premiums over paper. Charts looked broken. Correlation models failed. It was the kind of dislocation economists write about decades later. And behind the scenes, central banks started calling emergency meetings. Not about interest rates, but about metal reserves. Meanwhile, Chinese state media released a calm, almost smug segment on resource security. No fireworks, no gloating, just footage of gleaming refineries and the line, "A strong nation holds real assets." To anyone watching the markets, that was less a statement and more a victory lap. In London, the LBMA scrambled to reassure investors. They issued a statement claiming ample global supply, but traders knew better. Shipments were rerouted. Refiners prioritized Asian contracts. Western buyers were left refreshing empty order books. By March 2026, the panic hit the open markets. Silver prices jumped $10 in a week. Commentators flooded YouTube with headlines like "Silver shortage confirmed" and "COMEX crisis deepens." Retail investors piled in again, the new wave of silver stackers, this time joined by mid-size manufacturers desperate to secure feedstock. And through it all, China said nothing. No press release, no denial, just steady, relentless accumulation. The silence spoke louder than words. Because if Beijing's goal was to shift the center of gravity in the metals world, it was working. By April, the Shanghai premium, the price difference between Chinese and Western exchanges, hit record highs. Traders in New York began joking darkly. COMEX sets the fictional price. Shanghai sets the real one. But underneath the jokes was fear. Fear that the system built on leverage was finally colliding with the physical limits of the Earth. The industrial fallout came next. Solar panel manufacturers in Europe paused new projects, citing metal procurement uncertainty. EV companies issued statements warning of higher costs. Even semiconductor producers, who use minute but critical amounts of silver, began lobbying governments for stockpiles. Suddenly, silver, the metal no one talked about, was dictating the pace of the global green transition. In Washington, congressional hearings kicked off. Lawmakers asked the same question over and over: how did we let this happen? The answers were uncomfortable. For years, the U.S. and its allies relied on paper instruments, ETFs, futures, derivatives, assuming the physical would always be there. But when China moved, it didn't buy paper. It bought reality. A Treasury official described it privately as, "The moment the West learned ounces can ET be printed." The market response turned chaotic. ETF redemptions soared. Some funds halted withdrawals altogether. Mining stocks exploded upward as investors sought exposure to anything tangible. Silver juniors that nobody had heard of a year earlier were suddenly front-page material. And yet, even as prices spiked, the physical shortage deepened, because most of the newly mined silver was already spoken for, bound for contracts that ended in Shanghai. By mid-2026, the financial world was openly divided. On one side, the legacy system, COMEX, LBMA, and a century of paper-based pricing. On the other, a rising Asian bloc anchored by China, insisting that metal must back every trade. Economists called it the split standard. 2 markets, 2 realities, 1 metal, and investors had to choose which world they believed in. But beyond the charts, something deeper was unfolding, a geopolitical shift. When China controls the bulk of industrial silver, it controls part of the renewable energy supply chain. That means leverage in trade negotiations, in manufacturing costs, even in technological dominance. Suddenly, silver wasn't just a commodity. It was strategy. Western allies scrambled to respond. Canada and Australia announced fast-track mining incentives. The European Union discussed creating a critical minerals reserve. But mining isn't software. You can't spin it up overnight. New projects take years, sometimes decades. And that time gap is exactly what Beijing was counting on. While others planned, China was already stocked. Financial commentators started using a new term, the silver curtain. It described the invisible wall between those who had metal and those who had promises. Crossing that wall became increasingly expensive. COMEX responded by adjusting settlement rules, quietly allowing more cash equivalents in place of real delivery. It was a band-aid over a fracture line running through the heart of the system. By summer 2026, the silver spot price had officially broken away from futures entirely. The COMEX price hovered around $38. Physical bars in Hong Kong sold for $95. Analysts called it the Great Decoupling. And still, shipments kept flowing east. At this point, Western economists stopped asking why China was buying and started asking what they knew that we didn't. Theories flooded the internet. Was China preparing for a commodity-backed digital currency? Were they anticipating a global financial reset? Or did they simply recognize that in a world chasing electrification, silver would be the choke point? Whatever the reason, one fact stood unchallenged. China had cornered the physical supply, and the rest of the world was now reacting to its playbook. And just like that, perception flipped. Silver was no longer the poor man's gold. It became the strategic man's weapon. Every major think tank began producing reports about monetary metals in a multipolar world. Investment banks revised forecasts, predicting 3-digit silver prices before year-end. Suddenly, owning silver wasn't fringe. It was foresight. On social media, investors celebrated windfalls, but inside institutions, fear dominated. How many more assets were built on the same fragile foundation? Promises without backing. If silver could break, what about nickel or lithium, or worse, sovereign debt? China hadn't just bought a metal, it had exposed the fragility of the entire paper-based order. By autumn 2026, COMEX began restructuring. It introduced new physical plus verified contracts tied to actual audited inventory. Some hailed it as reform, others saw it as surrender. Either way, the lesson was written in molten clarity. The market that forgot reality was now paying to remember it. In Beijing, there were no celebrations, just quiet confirmation that policy goals had been met. China now held strategic reserves of silver large enough to influence both price and supply for years. And whether by design or coincidence, it had shifted global power, 1 ounce at a time. The world adapted. New supply chains formed. Western governments learned to treat silver not as a trinket metal, but as an energy lifeline. And for investors everywhere, one phrase became gospel. If you can't touch it, you don't own it. When historians look back on this decade, they might not call it the silver crisis. They might call it the moment the illusion